Today in this video, I want to share with you the process that I go through when I evaluate someone's investments, whether it makes sense for the goals that they mention to me, and whether I think they're just good investments overall. I'll share with you some of the metrics that I'll look at. There are so many metrics that you can use, but I'll share with you a handful of quick ones just to get you going in the right direction. The little bit of background on this, I met with a client. There were some investments that I had. They performed very well. And so he was like, hey, I have some investments that aren't with you. Could you look at them and tell me what you think? And I was like, sure. So basically he gave me the printout. It's like 63 investments. And then I will share with you how I start evaluating investments. And then you can decide as we go along, would you keep it or would you sell it? And I'll share with you some of the biases that we're fighting when we're making bad investments, some of the things that I look for and things that I think about when I'm going through someone's plan. And then hopefully it's going to give you a good idea of how many income streams you're able to create, how are you diversifying your income, and are you able to create something that lasts your whole retirement? Now remember, retirement is not the I'm old and don't feel like working. Retirement is I'm separating my time for my money. And I don't think there's ever an age that's too young to separate your time for your money, where you can work for pleasure, fulfillment, satisfaction, or you can work to keep the lights on. And I'm like, yeah, I think I'd rather work for purpose, fulfillment, and satisfaction. And the numbers actually show that 65% of self-made millionaires have at least 3 streams of income. That's why you always hear me talk about multiple streams of income. And the numbers show that about 7 out of 10 Americans live paycheck to paycheck. So from what I'm taking from this, the wisdom that I'm getting is one stream of income is very difficult to make it in the United States. Multiple streams of income makes it manageable. And then if you can get to the magic number of 3, at least 3, it seems like you can turn that into financial freedom where you don't have to think or even worry about money. So I will start going through these. Let me minimize this for you all. Okay. So I put the printouts here on the screen for you. Basically, what I will do is I normally will just start looking at the summary. So I can see that there is an unrealized gain, which means like these are the current values of the portfolio. And you can see that they're basically sitting at a $178,000 loss. And I was like, man, so they lost 61% of the portfolio's value. Normally when I see something like that, I'm like, man, this person stuck with these investments. And I normally want to know why would someone stick with the investments when you can see that they're losing money and you see that they're losing over a span of time. And I'll show you how I can sort of start telling how long someone's had these investments. But I'm often like, man, 61%, because a lot of people were so risk averse that just losing money makes it hard for me. But you'll find that actually some people with their risk aversion won't sell the investments because in their mind, they're like, it's going to come back. And I'll be like, yeah, I don't know if they're going to come back. And I think the way I think of it is if you want to make sure you're investing versus gambling, but I would actually say even gamblers. So I watched the World Series of Poker when I was going through college at Florida State. Chris Moneymaker was playing the World Series of Poker. So it was like everything that everyone was talking about. So I enjoyed playing Texas Hold'em. And if you look at some of the professionals that do it for a living, the professional gamblers will tell you, hey, I have a certain amount of money that I'm going to spend. And when that money is gone for that day or that week or that month, I'm done. Like there is a limit. And I think everyone, when you go into investments, it makes sense to have some sort of a limit. Like, hey, if this portfolio loses 30%, I'm going to cut bait. If these investments, if they shift like 40%, I'm going to cut bait. I don't care as much what the number is. Well, I guess I do sort of care what the number is. I just think that having the number will automatically put a lot of people in better positions. And so normally when I see that, I'm like, okay, that's tough. And so we can see that it says that the purchasing power is like $24. And I'm like, okay, purchasing power, right? What is basically how much money I can probably withdraw from this account. And then it says that we have a net account value of 140. So I find that to be interesting, that we have 140,000 left. We lost 178,000. It says that we basically have the ability to take out 24,000. I'm like, okay, all right, well, so we'll see what's going on. It says the day's unrealized gain. So it says that we gain 2% in a day. For the record, that's a pretty good day, right? If you just think about 2% in a day, I'm not sure what brought about that day. It's not how I invest, right? I don't care as much about the day. Honestly, I don't even care about the month. I look at it from a perspective of years, and I'm trying to find investments that I believe will be good for at least 5 years. Now, I'm going to build the case for why they'll be good for the next 5 years, And then if the information of that situation changes, then I'll reevaluate that. So if I say, hey, I like the leadership, and then the leadership gets like, I don't know, dies in a snowmobile accident, well, then I have to reevaluate it, because one of the things I liked about the company was the leadership. If I said, well, there's a great moat, it's a very protective industry, and then I found out tomorrow that AI completely destroyed that ability that they had where now everybody can do it, where I will go back and look and I'll be like, hey, the hypothesis that I made is not true anymore. The important thing about investments that I have found is if you have more information, you're going to make a good decision. That if you've ever bought like a bad car in your life, you knew once you had the car, like, hey, I have all the information. I would never buy this car again. And you recognize that whoever has the most information is able to make the best decisions. And if you make the best decisions, you have the ability to win. And investing in the stock market is about information, how much do you have, and your ability to win. When you look at our Congress people, they're literally just making millions of dollars, literally insider trading. And the reason they make that much money is because they provide oversight on those industries. And if you provide oversight, how could you not pick winners? And that's where people are like, oh, the stock market is rigged, this, that, and the other. It's not. If you have the right information, if you have all the information, then you're going to be able to make good decisions. So I did mention that it already had 63. And I can look kind of at the first ones. I will say when I see that you have symbols that aren't tickers, I'm like, man, that must be like, that's a really small penny stock is what I'm thinking. Because for you to have a company that doesn't even have tickers, when I say tickers, I mean the letters, right? So like the letters where it has the numbers. And I'm like, dude, that means that this company, let's say at some point it was registered on an exchange. It's done so poorly, it's worth so little that it's no longer qualifies to be on the exchange, so they take away their ticker status. And when you're looking at this, you can basically see that. It says the last price, $0. Last price, $0. Last price, $0, right? So that's not good, right? It basically means that I don't even know if the company exists anymore, but they're on the verge of bankruptcy. It says our total gain is 100% loss, 100% loss, 100% loss. Again, I'm sitting here and I'm just like, what are we holding on to these for? What is it that we're hoping will happen? Like, do we think that this is going to recover? Clearly, this person must have thought it was going to recover. I will then start looking at the price that they paid. I can see that this one was bought at $16.32. That's okay, right? So at least it's not like a penny stock. It's nothing too crazy. You bought a company that had a value, and it just didn't work out. We'll try to see if we can even figure out what this one is. This is one. Like, no, dude, no, right? That is actually smaller than like a penny stock. And you can see that we spent $4,000 on these tiny shares, and it's like, no. And then same with this one. You see that basically we're just going to say a penny stock to make it simple for us. And then we spent $6,000 on that. And what a lot of people are thinking is in their mind, when I talk to people, I always ask, hey, why'd you buy it? In their mind, what they'll say is, if it goes to $1, do you know how much I'll have? And I'll be like, well, of course, you'd be like a billionaire. The question becomes, what's the probability of going to $1? What is the likelihood of it going to $1? Why do we believe it's going to go to $1, right? These are all questions that I will ask and I will think through. Let's just see if we can actually find any of these. So I'm actually going to use like my program. So you'll see a little bit of my back office where I do some research on stocks. I do recommend for people that don't have access to all of the information that I do, I like markettrends.net. I've used that just as a free resource, and I like it a lot. So here, let me see if I could put in that ticker. I think it was like 33813J106. It's probably not going to show up, and it is not, right? Because it doesn't exist like that. Let me see if I can even go into Google and see if I can find this one. And so we'll just say like stock. Let's see what we got. It says corresponds to the common stock Fisker Inc., formerly FSR, now FSRNQ, following significant financial distress and delisting from the New York Stock Exchange, right, as I just mentioned. In early 2024, the company filed for Chapter 11 bankruptcy, of course, again. And June of 2024, the stock now trades over the counter under a new ticker, right? So this company is literally doesn't exist, right? Literally, this company does not exist anymore. So based off of that, filing bankruptcy, losing all the money, right? So that's not a good look. And then, as I mentioned to you, lost the ticker. No surprise there. So then let's move on to the next one just to kind of confirm it. So it says 458. That was 25D109. See what this one is. It says Intelligent Highway Solutions, stock price. Yikes, it's still right. It's still down there. Let's see what they have to say about it. All right. So the buy, sell, the charts. So you can see this is from 2021. Okay. When I'm looking at that, I'm like, all right, then what does that mean for the company today? So it has 2 employees, not a good sign. In the industrials, transportation, okay, transportation not an issue by itself. I'm looking at this stock and they're showing the revenue, so it's making like $633,000. And so it's not even $1 million company. So 2017, it broke $1 million, so 1.4. And then 2017, it started losing some of the money. And so it was around $1 million. When you're talking about investing, if a company, I'll put it this way, to put it in context, the capitalization size, like the size of a company, if you took every single stock that's available and multiplied by the price of the stock, that's the size of the company, right? That's the market cap. That a small cap, so right, these are going to be small regional companies. Those are normally going to be around 100 million and maybe to like 1 or 2 billion, right? So for a company to be about $1 million, right? That's like way off the radar. Probably not a company that you want to be investing your money in like that, because they haven't shown me the proof of concept that they're going to be able to take this money and grow something, right? We're really teetering into angel investing at this point in time. And unless you know the company in and out like a shark, like literally from Shark Tank, you probably don't want to be angel investing. And they'll tell you the numbers of angel investing. I mean, it's not good. I think the angel investing return is something like 90% of them don't work. So angel investments returns, or success rate, I probably should have said. So let's say angel investment success rate. There we go. So angel investments, right, high risk, high reward, roughly 50 to 70% result in a loss of capital, while 10 to 20% drive the majority of the returns. Right, so do you want to be choosing these small companies that have not been able to pan anything out yet and be investing in them with your money as an angel investor? And I would say no. So the way we're going to do this is we're going to do it like red light, green light, yellow light. So this is red, sell, red, sell. And the tough thing is, I know when I see someone holding these positions and they've lost everything and they're still holding them, I know that means that person probably thinks that it's not over yet, that there's a chance that it's going to come back. But based on just the small research that we did, I think you and I were probably going to say, yeah, I don't think these companies will come back, right? We're talking about delistings, filing for bankruptcy. We're talking about companies that haven't even reported their numbers in multiple years, right? Like, I mean, you're really starting to say, yeah, that's not looking right. That's not looking good for us, because I'm like, okay, when's the last time that you reported some numbers? And this is talking about 2021. I don't even like, that doesn't make me feel good. All those are signs like these companies are basically dead, right? So it's, so then we would, I would put this one on the red too, where it's like, yeah, we're not going to do that. The fact that it took that much effort to find it. I'm not going to look up this one. They've already lost everything, so it's going to be the same situation. So then we will keep going. Now this one, it says the price paid. So I look at that. So it said they bought it at $14.35. And then it says the last price was $16.26. So we have a gain in the portfolio. So they've realized the gain of about $375. The value of this is $3,252. And normally what I would do is, let me pull out a calculator. So I just want to have an idea of how much of their portfolio does this one stock take up. So we have about 140,069. And so it says it's about 2% of their portfolio. I just like to have a general idea. Anything that's over 20% is normally going to be something that makes me a little concerned. There are 63 shares in this, so we're probably not there. If you're wondering, if you could really get up to 30. If you had 30 shares, you're probably going to be, right, you're gonna have a well-diversified portfolio. That any 25 to 30, you're probably going to be okay. Once you get over 50, you basically have an index fund, right? Like you're just going to kind of be blended in to the average market's return. So for this one, it says ADMA. So let's see what we can find on that one. So we'll say ADMA. All right, so that's good. This company does exist, so that's great. So we want to look at it. So we can see that the company steady growth. Had something happen right around 2024, exponential growth, and then it's basically back at the steady where it's kind of hovering around that. If I was to try to figure out where they bought it at, I would start looking at, so the earnings per share, so you get about 84 cents per share. The PE ratio, the price per earnings, is 19.2, which means it's basically about an average price, about the average in the stock market. Is the price per earnings are gonna, let's see what it is. It's normally like 15. So we'll say the average price per earnings in stock market. So historically around like a 2025, you're going to be okay. So then we'll go back to that and we're like, all right, so we're around that 20. So then we're like, okay, so we're okay as far as earnings, which basically is a very simple way of saying this company is actually generating the money that the price I had to pay for it justifies. And that there are somewhere it's a sign that we're speculating if the price is too high, where it's like literally the price per earnings, where we're saying for every $1 earnings you receive, you have to spend $20 for every dollar earnings you receive, right? So that's about the average. If you are spending $100 to get $1 earnings, that's how much of an investment you're making. It's before you have to wait to get that return. And if you ever watch Shark Tank and stuff like that, they're always crunching the numbers of how much they have to put in to get a return. Like if you're evaluating the company at this amount, then that means it would take me this long to get my return on my investment. Because it's not always whether the company is a good company, it's whether it's at the right price as well. Now, if we have a super long horizon where it's like, yeah, I'm going to be around for 20 years, then it's okay. Because in 20 years, if you pick a good company, it's going to give you a good return on your money in that 20 years. All right, so anyways, we can sort of see that. So I'll normally click and see if there's any news on the company and I'll read about it. And so I won't bore you with that, but that's what I'll normally do. So as the holidays wrapped up, the quarter ended, many companies posted guidance, and here are some notables. And then you'll normally go through that. You take a look at the charts. So the way that my back office works is it's made for any advisor that whether you're someone that wants to do, trading on charts or whether you want to use the fundamentals, they give you the ability to look at the numbers any way that you like to evaluate the stocks. And then you can decide what makes the most sense for you. Now, we're just talking about how information is what's the most important thing. And so you're able to, once you decide, hey, this is a company that I think is worth keeping or investing in, we can really start looking at all the information. So if you're on the fundamentals, I generally am more on the fundamentals than a technical aspect of using charts. And so you'll look at the balance sheets and you'll see how the numbers match up. We like to look at it over multiple years. And so you can see that the cash and short-term investments, and you're like, okay, let's see how we're doing. You're like, okay, in Q3, and then we grew, and then something happened in Q1 of 2025. I might look at that, but we bounced back from that in Q2 of 2025, or at a minimum, maybe it's a seasonal business. I don't know, but we'd have to start looking at that to see what makes the most sense, because it's like it's low and then it's high and then it goes back to low, then it's high and then it's low again. Your total inventory, we want to see whether their inventory is increasing. You can see that the inventory is increasing, which might show a sign that they are losing steam. It takes a lot of time to really kind of go through these. And that's why normally you tell people that if you have 20 to 30, because if you go through and evaluate the stocks the way that I'm talking about, it would be very difficult for you to do that with 60 companies, right? Like, so for this one, it would be hard. But if you only have like 20 of them, you could do 20, right? But you could do it in a month. You could do one a day. It's been like an hour just reading through the financials, seeing what the company is doing, reading about the news and everything. And then you could just see whether it's doing well or not. And then depending on how it's doing, you can then decide whether it makes sense for you to invest in that company. And so we'll go through a lot of the numbers. We'll compare. You'll look at the cash flows to see if they have any money. That's another way to come up with the value of a company. And you can say, well, dang, man, they were struggling. So again, like Q1 of 2025, like, man, they were struggling. And then they were gangbusters in Q4 2024. They've been able to recover in Q3 of 2025, and then they'll get the numbers for Q4 2025, and we'll see if we have a trend. Then you go through the numbers, so you see their accounts receivables are increasing, and you're just kind of like, okay, that means people owe you money, right? Who are you giving money to? Inventory, we already saw that was increasing. So you're like, man, what's going on? It says changing in working capital, right? So you see some of the signs where you're like, okay, as far as cash, I'm not sure how I feel about this, about this company overall. And so this one, I would probably place on the yellow, right? Because for the sake of time, we'll kind of keep it moving. I'll make it a little bit darker. We'll put this one on a yellow. We're not saying that we have to sell it, but we are saying that this one is probably going to be at least a consideration from a timing perspective, that there's a level of risk that's here. We can see some of the upside as well, but there's a level of risk that we have to make sure it's aligned with the portfolio. So this one would warrant a better look. Let's see here. So we'll go back to the red. AI. All right. So we already know AI. All right. So the last price is $10.97. The price paid was $40. So I can already tell, that you basically lost most of that, right? You paid 40 for it, you're down to 11. So you lost about 70% of that portfolio. I can then see how much you bought it for. So you lost about $22,000. And you have about $8,000 left in this portfolio. Very volatile stock. How do I know? Because it had a 6% change in one day. That's crazy, right? I mean, a company should, relatively speaking, it shouldn't be that volatile that it could change 6% in a day. All right, so let's go and see what we got on this company. Well, yeah, look at that. Look at that in 5 days, right? That's a big change. Let's look at it in 6 months. 6 months is not trending in the right direction. That we can see a steady decline. Year to date, same idea. You can see a relatively steady decline. So the 1 year outlook. So we can see that they have peaked around here. So what price did he buy it at again? He said that he bought it at $39. So if you bought it at $39, that means that you didn't buy this one in the last year because it wasn't even above 35. So you go to the 3 year outlook. And then I can see that it did break 39 in October of 2024. Does that break it? And definitely in July of 23. So he probably got it around this time. So he's probably had it around 3 years. And that would make sense because we can see that, you basically have lost 70% from this point in time. And so that's where he's at now. When you're looking at it like that, whatever number you would have put on it, right? We talked about a little bit earlier, where it's like, all right, if this loses 50%, right? A high percentage, a high threshold, but let's just say it loses 50%, I'm out. Like, it doesn't matter. I'm going to sell, right? Like, you just want to have some stop gaps in place. You don't want to just keep going saying that this is going to recover. That we can see that there was a huge shift just in the past year, ranging from $30 to $9. is crazy. And so there is a little bit of action on this. So the puts and calls, these are just the options. That's not a lot of action. So the market size, it says as 1.4 billion. So we do recognize it as a small cap, right? So we said that it'll be considered a small cap, and the outstanding shares held by institutions, 52%. The reason a lot of people look at the shares held by institutions is because if institutions normally going to be like banks, insurance companies, if they're holding them, these institutions, that it's can sometimes mean that this company is a safe investment. Well, that's sort of what we're saying. The reason that I'm not someone who just automatically will say, well, clearly that's the reason, is because Enron was a company that everybody had owned and had given great ratings to, and yet Enron filed for bankruptcy and it was gone. So I'm going to look at the company profile. It says C3 AI Inc. is an enterprise artificial intelligence application software company. The company has built a solution that enables its customers to rapidly develop, deploy, and operate enterprise AI applications. And then it goes through some of the software programs that they offer. We'll look at, and then you can read about them if, just depending. I'm probably going to put this one as a red because of just how much is lost wherever the number is. But we could always start looking at the executive team and we can see what these people are talking about and what they're doing. And then we can decide if you so saw fit. They always have the little phone number. That's for investors relations. You can call these people up, try to get the insight. They will tell you as much as they can without consider insider trading, unless the company's doing really bad. But if you talk to them on a regular basis, it's very possible that they will give you a tidbit of information that can give you an edge. And that is why the hedge funds, that's why they do that, right? They talk to these people all the time. They go on every single call because they need the information. And you never know what they will say that will give you an idea of how much that company will be worth in the future. I actually knew someone that the way they ran their firm is they had paid basically a call center. So like, let's say they went out to India and they paid a call center of like 100 people in India, and they had them call all of the companies to talk about investor relations. So that way they can get the information that they need, and then they can make the best decision on what their investments are. If you are someone that's going to be investing in some of these smaller companies, then you would basically have to do it like that. You have to really get to know these companies, understand exactly what they're doing, and then see if that makes sense for you. There are, so they give you ratings on them. So Schwab says that they're a D company, which, is interesting, right? Institutional investors have 52% of them, which you and I would probably say is, yeah, that's probably okay. Just the numbers that I was looking at, I was like, no. No. But the analysts at Schwab, they gave it a D. You can see that the CFRA's opinion is to sell, right? So they got hold buy, strong buy. They're like, no, bro. If you have it, sell it. And if you don't buy it, right? But then you do see there are some, the LSEG, they say to hold it. And then you and I would basically have to decide whether or not that makes sense. Then you have the MSCI, another rating agency, they gave it the BBB. I hate the ratings, by the way, because it should just be, right? Don't you just feel it's weird that you could be a single B and still be considered basically a bad investment speculation? That it should be like A, B, C, like F. That someone should have an F, but there's no Fs available. The lowest you can get is a D, and those are super awful companies that when you see a C or even a B, you should be very cautious because of the way the rating systems are. Because it'll be like AAA, AA, single A, and some of them will be like A, B, and then BB, and you're just like, man, that's so hard to be able to tell. But the majority of the consensus of the analysts that have researched this company, they're like, dude, you can't do it. But like I said, if it was something that you were like, oh, I really like it, then you would kind of take some of the information. You could always go to the website, see what they're doing. Let's say they have 15 years of enterprise AI success. So they have the industries that they work in, some of the events that they have, the resources in the news, and you can read about it, about the company. You can decide whether that makes sense. Like I said, for this particular situation, seeing that we bought it at 40 and it's at 10, do I think it's going to grow that much? I don't. Do I think that we should probably cut our losses? I do. And so even if I was to Like really, I mean, you really can't. Like you really can't. I'm trying to think through some of the things that maybe would have me change my mind, but I just really couldn't. Like I really couldn't. The numbers, right? So the price and the sales, yeah, it's not like return on equity. No, it's not there, right? It's just not there. The numbers don't pan out for this, but you look at it from a variety of angles. You see if something is going on, but I would definitely sell this one. I agree with the analysts that say sell. So we move on to the next one. See that this one's already lost 99% of its value. Bought it at 42 and it is less than $1. I'm not going to waste my time. That is a sell. Come on, I mean, they're about to be delisted. So that one's not good. So AJYG. Let's see here. AJYG. It's basically flatlined. You see that, right? Like, oh, that sucks. So you can tell, yeah. So these, I can see he must have bought it around there because it said he paid $42 for it. So that would be like right here. So ouch. So he bought this one in 2021, almost basically at the beginning. So he basically bought it at the moment that it listed at the IPO. And then you can see he lost 99% of his value. So that one's not looking good. That's unfortunate. So depending on how close you are to retirement is whether you decide you should invest in IPOs, because all an IPO is a bunch of analysts that come together and they all give an opinion, but then they all sort of agree with each other and kind of read each other's opinions, and then they come up with this consensus of the value of the company. Sometimes the company is worth way more than that and you're going to get it on sale, and sometimes the company is worth nothing and it's going to immediately drop and it's never going to come back. And so it's basically gambling. I would personally wait. I would not join an IPO, especially if this is investments for your retirement. I would wait to see what happens when the market kind of adjusts and ebbs and flows. It's okay that we don't get the home run, because if you watch baseball, the home run hitters have the most strikeouts. And I'm not normally in the business of getting the most strikeouts. So we want to have base hits. And if there's an ability to make a double or a triple, we go for that. And if every now and then we have a home run, that's fine too. But the idea that we're going to go for broke, that we're like, this is the next big thing, it's never going to be below $40 again, buy it while it's high. And then look at it. It's never been above that. It's like it came out and immediately lost all of its value, which is unfortunate. So that one is a red as well, as we mentioned. All right, this one lost 100%, same deal. AMC or movie theaters. What's AMC doing? Oh, I got Entertainment Holdings. Yeah, AMC is the movie theater. Yeah, AMC's been around. So AMC would have lost some during COVID, I would imagine, right? So the COVID loss, theaters started reopening, they skyrocketed. People felt very optimistic. Movies are back. And the speculation drove, people got a case of FOMO. You're like, oh, movies are back. Jump on the bandwagon before you get left behind. And then they jumped on the wagon, and then movies kind of like flattened out. And there's been a couple companies that have been even talking about buying AMC and different things. But that's ugly. So this one is currently at $1.28. Bought it at $292. That hurts. That's tough. That's tough. Bought at $292. And that's really tough, right? Because you rode the loss all the way down, right? We could have put the stop loss at 200, at 150, even at 100. We're being like super optimistic. But to let it go all the way to $1, that's done. So that's done. BA, so we bought it at 200. It's at 242 now. That's nice, 20% gain. All right, so we have 2 shares of this one. Let's see what BA is. Who was that? All right, we'll get rid of that one. So we'll see who BA is. My friends, Boeing. Okay. Oh, of course. I mean, Boeing's not going anywhere. Boeing's been around a while. They have a lot of government contracts. That's kind of what keeps them afloat. They do get some bad press sometimes, but for the most part, when you look at the government contracts, there's government secrets. They don't want to just give it to everyone. So it's very hard for the government to agree to give contracts to other companies, even if they possibly could be better, because they don't want everyone to have it. Now, as far as the volatility, you can see that it's very volatile. It's just kind of going up and down. As far as a long-term investment, where I needed to have a steady growth, you and I are probably going to say that this isn't going to pass that. So it says, so they filed a form. We're not going to read that. So the other way is profit soars nearly 50% as fleet network expansion supports strong demand. You're like, oh, okay, well, that's good. XTJ sentenced to selling fraudulent airline parts. That's unfortunate. And so it says Form 4 Boeing Co. file, right? So you just kind of would go through the news and see what Boeing is doing and how you feel about them. I do like looking at some of the overall reports. So let's see what we have on Boeing and the reports. So all the reports are saying is that there's some analysts that read and specialize in certain industries, certain companies, and they will give them grades. And they'll tell you about the company, how they've been doing. And so, right, so talking about Boeing, it says strongly underperform. It says 97% percentile, so they would say sell. When you look at the stagnation, it sort of looked that way. It says price volatility outlook, says below average price volatility. I would agree with that, because if you look at the chart that we had just looked at, it's going up and down, so that's not very volatile. It's not volatile because of the way they measure it, right? So if you just said, hey, what was the price at the beginning of the year versus the end of the year, even though it's going up and down a lot during out the year, you would say, yeah, it's sort of hovering around that same average, right? So I understand that. Below average volatility, growth rate is negative, not looking good. Quality grade is negative, not looking good. Sentiment is neutral. I think Boeing's had a couple of, what is that, bunch of, well, I forget what the name of that one plane was where the doors were falling off and stuff, so I understand that. Stability grade is negative, valuation grade is negative. All right, and then it gives you the numbers here on the business summary. So it lets us know the market capitalization, right, about 200 billion, so this will be a large cap company. And that's what they say as well, large cap. Beta is 1.4. Beta is the volatility, the risk that you would measure. And then the sector is industrials, aerospace, and defense. Yep, we recognize all that. And then it gives you some of the numbers compared to the SP 500. The last PE ratio, price per earnings, is 103. Super overpriced. Overpriced is strong. I know. Sorry, Boeing. We would just simply say that it's priced really high. We'll say it's priced really high. That I have to give you $100 to get $1 of earnings back. That is priced kind of high. The PE forecast, earnings per share. So they give you that compared to the market as a whole. This is called a benchmark, where it's like, hey, if you just got an S&P 500, which is any of the other large cap companies, right? 500 largest companies, then this is going to be one of those large companies. So we're going to compare it to that. That's where the benchmark comes in. There's no dividends here, right? Dividends of the average stock. The 1 year forecast of earnings per share is actually forecasted to lose 78%. You'd be like, no. Or at least maybe some, yeah. Where you'd be like, yeah, that's not looking good. 4 week stock price change. Yep. So you can see that it's relatively speaking, it's not looking very good. Then you keep going. So it has the recommendations of different rating agencies. So that's always nice. And you can see that there's like a 3-star. So they have up to a 5. It says if you bought it, you can hold it. And the market edge opinion is right long, which is saying that you would basically buy it. And then you have the rooters that says like outperform. So everybody's a little bit different. We look at the numbers, and then you come to your own conclusion based on what you believe. You're probably like, hey, I think we're going to go to war with like a gazillion countries. I think Boeing's going to have a lot of contracts in the near future. Yeah, I mean, if that's what you believe is going to happen, then yeah, Boeing stands to gain from that. And then, but as far as just where they're at now, and again with the timeline, and then how much gambling you're willing to do, that's how you would decide whether that makes sense for you. Morningstar is another report that I do like. So Morningstar said we're at 3, says the moat is wide. We already talked about that. Why? It's a large cap. Yep. Uncertainty, yep, is high. And then they're recognized concerned about that. Fair price value. So it's saying, hey, the price is at 244. We think 246 is the fair price value, which means that basically we think it's at the value that the company is, which means there's not going to be a lot of growth. And that's what we saw. We saw that there wasn't a lot of growth happening. That's basically what this is saying, that if we're saying it's fairly priced, so if you have it, sure, hold on to it, no problem. Or you can sell it. Normally people say, Dre, when do you sell? I normally would say you sell when you have a better place to place your money. So if you have somewhere that is going to give you a 5% return, a 10% return, then I would sell it and get that. Because this is basically saying you're going to have around a 1%, 2% return, which you and I would probably agree with. So we have some of the analyst notes. It says Boeing delivered the 1117 and the 737 and the 787 jets fourth quarter up 22%, 80% respectively since 2024. Also recorded $600 million in losses on its KC-46 tanker program for the U.S. Air Force, offset by a hefty $9.6 billion gain on the sale of its digital aviation business. So they give you some of the information. When I see the selling of a part of your company, that you probably hid some of your losses with that, because you can't sell all of your company. So you're like, oh, we'll sell this and then we'll hide some of the losses and we'll look good on the numbers. Maybe we can get a couple of analysts to say that this is a good investment. Normally when I see that, I'm like, oh no, that you look at the strategy. So it says Boeing, major defense, historically made most of its money manufacturing large commercial airplanes. Its narrow body planes are well suited for high frequency, blah, 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 blah. Worldwide sales of narrow bodies have increased faster than wide bodies over the past 20 years, right? So we're talking about how are they positioned? And you're like, hey, their positioning is good. Their business, unfortunately, was battered by the extended grounding of the 737 MAX. And you remember that was one where the doors were like, I think those doors were falling off. There's just weird stuff going on with those planes. So they had 2 fatal crashes of the plane before the COVID-19 pandemic. So people were like, I don't want to fly in that plane, which of course they would say. And then you would discuss whether or not you think it's going to recover. One thing I do like about Morningstar, and again, the data, the information that you would have, this is what I use. I understand that this is not going to be available to everyone, but this is the kind of stuff that you would need to feel confident in your decision. You look at the numbers, you have an opinion, and then you start looking at the data to see if it still matches up. What I can see here is it gives me their competitors, and then I'm going to compare them. So I have the fair market price and then the last closing price. So this one shows that there's opportunity, because we're saying that it's underpriced, just a little bit, but underpriced. This one, we're saying that, we actually think that this company is worth $630 and it's currently at $678. So that means that this is overpriced just a little bit. And then same here, slightly overpriced, same here, slightly overpriced. And so I don't think that inherently means that you would buy Boeing. It's possible that I don't mess with any of them. Right? It's totally possible that if I can't, Warren Buffett said that it's like investing is like waiting for your pitch, and you can swing at any pitch you want and you can let as many balls go by as you want. So there is no striking out by not swinging, that you don't have to swing at any pitch that you don't want to. And that's how I feel. That I'm looking at this, none of them look like good choices. I don't think the fact that these are worse choices means I buy Boeing. All right, so that is me and my opinion on that. But with that said, based on the information, where would you rate this? I'm gonna put it as a yellow. Put it as yellow. So we have 2 yellows and we have 6 reds so far. So we're not gonna do. I'm not gonna do all of them, but you get it. You can sort of see what's going on here. All right, so the next one, I can see that it's at $3. That's kind of low. And I have 10 shares, bought it at 19. That kind of hurts. So yep, that's 81% loss on that. So I'm gonna sell that, because whatever my catch-all would have been, it would have been triggered by the 80%. In fact, I'm going to just go ahead and just kind of anyone that's like basically lost almost everything. All right, all that one's gone too. Curious what that one is. That's new. BioX. Let's see what that one is. This is Core Solutions. See the company profile. It says productivity technology is designed to enable the transition of agriculture towards carbon neutrality. If you would have told me that this company existed, I would have said, well, the political climate probably not in your favor, my friend. The current administration of the United States does not care about being carbon neutral. So I'm like, look, man, if you said, Dre, where do you think that's going? I would say, look, I'm going to be honest with you, my friend. I don't think that's going to be looking good. Because carbon neutrality, right, you have to have an administration who cares. And the current administration has left the different climate accords and closed down satellites that were doing climate change, all that stuff. These are all signs that you're in a hostile industry. You're in a hostile sector. You're not, right? It's like buying newspapers. Nobody's really reading newspapers. What do you want me to do? That we can't really be doing that. So that's a tough one. That is a tough one. Yeah, if we had talked about that, I'd be like, yeah, man, that's not going to work. So that one, yeah, you gotta get out of that one. So this one's at 93 as well. Man, there's the cake and killings. This is at a 30% loss, so I'll leave that one because I'll look at that one. This is at a 23% gain, so I'll look at that one as well. 82% gain, that's interesting. So it says that you purchased it at 17 and it's at 32, right? So that's done really well for you. And so we'll look at that. This one's lost everything. So that's gone. Yeah, probably 50%. Not going to mess with that. I know that the thought is, well, do you know that it's not going to come back? It's how much of a comeback we would need. That it's not about the company, whether the company is good or not. It is sometimes just about what you paid for it. And based on the fact that you paid $3 and it's at 44 cents, no. Based on the fact that you paid $101 and it's at 53, you're like, no. Then, so 83% loss, right? Bought it at 17, it's at $2, no. 145% gain. That one's interesting. So we bought it at 92 and it's at 227. Let's see what that one's doing. FSLR. So FSLR. First Solar. So that is pretty interesting. So let's see what that one's doing in the news. Slides as outlooks fall short of Trump era permitting delays. Yeah, that's not too surprising, right? We just talked about that. Energy, solar, not going to be a super nice administration on that. It's obviously the company has done really well, but it doesn't change the fact that they're going to face some headwinds, right? We'll just put it that way. Face some headwinds. Plunges after downbeat net sales forecast. It says enter into patent licensing agreement for U.S. markets, right? And so that probably gave it a little uptick as well. Right, so you're looking at it, you're like, okay, right? I can see a little mixed bag here. This one is probably right. If you're going to say the administration is going to be not favorable to solar for the next 4 years, I would definitely consider selling it. That there's probably a better place to place your money that's more advantageous in the current climate where we're looking at a 5-year forecast. I'm not sure that this company is going to be good for 5 years. And so that's sort of some of the things that I am looking at when I'm trying to make those decisions. So their total assets have been steadily growing, so that is good. They had a little hiccup there. I mean, but they've been steadily growing, so that's good. Their total liabilities have been increasing as well. And then their shareholders, total common shares outstanding. So we have that. Yeah, it's definitely a mixed. It's definitely a mixed bag. So we'll place that one at yellow, and we'll at least keep an eye on it. It's definitely possible that the wind is not at our back anymore. And so it doesn't make sense in our investment portfolio anymore. So we only have 2 shares of it, so we're not going to overthink it too much. So this one is at $0. So you're right, you lost everything. $3,000 on that one. Let's just officially get rid of that. Lost 100% on that one. So you bought it. You bought it at like $1.17, and it's basically nothing. So we'll probably get rid of that one. That one has lost everything. Bought it for $5.60. It's basically at $0. Get rid of that one. INMD. So you lost 25%. That was not as much of a slam dunk. I'll come back with that one. Right. So this one, that one's not looking good. I'm probably not. Especially when you take someone's age and the fact this is their retirement income, probably not going to mess with that. Even though this one has a lot of growth, I'm looking at it, and this one has a good amount of growth as well, looking at it. It is one of those things where when it then has to make sense for their plan. Like when you want to retire, the income streams that you think you're going to have, how do we feel about this company in the future? And so let's look at this one. So that is LYZ. 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 Did I mess something up? Must have missed it. LYV. You're probably saying it right. You're probably like, V, it's V. All right. And this will look like showing his growth. He's had a lot of great growth. Market capitalization, 36 billion. So that'll make it a large cap. Normally, if you're going to be a small cap, it's going to be 100 million to maybe 2 billion. Then like 2 billion to like 9 billion as the mid cap, and then 10 billion as larger is normally going to be a large cap. So this one's going to be considered a large cap. 80% of the shares are held by institutions, right? That's a good sign, as we had mentioned. Doesn't tell us everything, but it is a part of the information that we would take. So look at some of the key fundamentals. So the revenue, Q2 2025, 7 has grown. I'll be curious what happened in Q4 of last year because it dropped a lot. And then the projection so far for Q1, well, we're halfway through, so I guess you may be okay. Like you may be okay. So we'll have to kind of see what's going on for them. Yeah, it's not a dividend. That was my mistake. Then I could look to see what some of the analysts who specialize in this, most of the companies, when you have 80%, that's going to be a lot of, that means that there's probably enough research, enough of the data and the numbers on it. It says that right above average price volatility, that's probably fair considering that he had, what was that? Considering that he had a 179% return, that's still volatile. Even though you're like, but we made the money. Yes, we didn't make the money, but it doesn't change the fact that makes it volatile to have moved by almost 200%. It says it's currently a hold. So they're like, yeah, I mean, you got the value. So the growth grade, how could you not be positive on growth? The quality grade is neutral. Sentiment is neutral. Stability grade is negative. It's very volatile. So that's why valuation is going to be neutral. We're saying that, yeah, there's a lot of growth, but it basically made sense that this company is worth that. We understand where the numbers came from. And because we understand where the numbers came from, we believe that it's probably fairly priced. That's basically what they're saying. So we're saying it's an average company. They're going to be long, outperform. Morningstar gives it a 3-star, about average across the board. Then you look at the revenue, and yep, we're both kind of basically saying and seeing the same thing. Revenue exploded, this grew a little bit smaller, and then we lost it at the end of the year. and we haven't quite got it back yet. So we're just not sure what's going on there. And then they will place some of the information that some of the analysts are saying when they're going through their numbers and why they think it's good or why they think it's not good, right? So that's kind of where you look at those reports. So this one, I know you're thinking like it's going to be green. I'm like, no, it's not going to be green. It's going to be yellow. It's going to be yellow. When you think about growth, if I told you something grows on average like 20%, and then you had a 20%, well, let's say you had a 40% year, then that means it's more likely that next year you'll be at 0%, so that you're still at the average of 20%, than it is for you to have another 40% year, right? Like it's more likely because you're going to be the average. If you just keep growing by 200% all the time, then what are we doing, right? Then your average isn't what it was, then it's something different. I haven't really seen a green, but I believe that there's probably one here, right? So that one's got to go. Right, this one's got to go. 40%, so we got it. Looks like we got it at 43, and it's down to 25. We have 5,000 shares in there. NNE, 40%. I'll come back to that one. All right, so then we can see the 99, 99, 92, 99, 75, 99, right? This whole page is probably bad. Look, it says run. I feel like, did you think that through when you got your ticker number? It says run. Like, I don't know if you want your ticker to say run. They would say it means run to it. I'm like, no, it means run from it. It means run from it as fast as you possibly can. But you can see that most of these, I would sell most of these. Most of these should have already been sold. But I would sell most of these just based purely on just walking in and like, okay, you bought it for 44. Oh, it's at 14? Yep, sell it. Well, it's going to come back. I'm like, well, what would that look like? Because if you grew by 10% this year, that means that it basically went up to $17. So how many years would you need a 10% growth to get back to 44? And then that, when you do that math and the person is retiring and they're up in their years, it's like the time horizon doesn't match. That even in this, let's say this is a good idea for someone that's maybe 20, is because they have the time. It's not a good idea for someone that's 60. And so we're going to cut that one. All right, and we're going to cut these 3. Those all got to go. All right, let's see if we can, Teva, let's see what we got there. Pharmaceuticals, ooh. That is actually one of those industries that is positioned pretty well, because if you think of baby boomers and they're retiring, they're the largest generation in America. So anything in healthcare, as I've seen, is just generally doing pretty well. And so that's not a surprise for me. Right, so it's been kind of steadily growing, and then you start seeing the growth. That's normally a good sign. So we're going to say the beta, the risk is low. So I do like that. Market cap, it's a large cap company. That's pretty good as well. 60% owned by institutional investors, so that's decent too. And then let's look at, so the company, let's see what they do. It says an Israeli-based pharmaceutical company. Company operates through 3 segments: North America, Europe, and the international markets. Each business segment manages an entire product portfolio of its regions. Yada, yada, yada. Third-party information. So sometimes I will look up the executives when I'm getting closer to making that decision. Economic moat says none. They don't have any patents on their medicine. They just sell the medicine, right? Pharmaceutical company. So you'd be like, okay, well, that's that. I won't say it's a red flag, but I will say that you sort of would like them to have something. I assume that maybe their relationships are probably going to be maybe the moat. That's the only thing that they have. They don't actually have anything else. So let's take a look and see what we got here. All right. So they're saying a fair value of 28, last priced at 32. So they're saying it's over price, high level uncertainty. It's definitely a large cap as we went over. Capital allocation is phenomenal, they said. Looking at other pharmaceutical companies, you can see here, right? So they're like, yeah, I mean, they're doing pretty well. And they're all about the same. So you see a couple 2 stars, you see 1 3-star, fairly valued, overvalued, right? So they'll probably be relatively speaking about the same. It says the 1-star price is $43. The 5-star price, which is saying like this is the deal of the ages, where if you were to buy it at $17, if you believed it was worth 28, right? What we're saying here is if it went down to 16, you believe it was worth 28, then you're buying it on a sale where you already are going to be able to see significant growth when it comes back to its actual value. And so that's what makes it a 5-star, right? As we mentioned, it's sort of the price that you pay that also determines it. So while this might not be the time to buy this one, I would say it's probably would be a good time to hold this one because it's right around the value that it has. And I do think pharmaceuticals, I think that you're probably going to be in a good spot. Looks like there's a couple rating agencies that also agree with buying it. And then you can see, again, it's about an average company, and then you would kind of go from, there. And so we'll see what the last prices were and what people think the prices should be. Looking at that, and you're like, okay. So the growth of a $10,000 investment, that's what the total return is. So if you invest in Teva, you'll see that you would have outperformed the S&P 500 and you would have outperformed healthcare. So basically this is saying they're in the healthcare industry. So if we just had a healthcare ETF, so we just took every single healthcare company available, placed it in here, then what would that have been, right? So that would have been here. The index funds and ETFs, right, they're only going to be, relatively speaking, a little bit flatter because you have the good and the bad. You have all of them in the industry, but you can see the growth has been relatively consistent over the past 5 years. They are positioned well. And so this one, ladies and gentlemen, I think we may have found our first green. I think we may have found our first green. Was it? I think it was that, right? Yeah. Congratulations, right? So you won. Okay, let's look at this one. Is that Tesla? TSLA? I think that's Tesla. Whoo, man, Tesla is a tough one. Tesla is very volatile. I would not wish that on many people. It keeps growing, right? It's a $1 trillion company, so you got to tip your hat to them. But man, that's going to keep you up at night. That's going to give you some stomach aches. So we have one share of Tesla, so probably not going to worry about that. Was able to get it for $240. It's at $420 now. Congratulations. We'll keep the Tesla. And then the TSM, this will be our last one. Ooh, I already like them. I do. I do. I like the Taiwan Semiconductor Manufacturing Company. They have a pretty good moat. They make great chips. They're getting a lot of pressure, though. They have pressure from the United States, where they're like, hey, you got to invest in the United States. And they're like, sure, we'll invest. I don't know. I think you said invest like $100 million or $1 billion or something. But then like, we want more, and we want you to bring jobs. And they're like, well, we can't bring jobs. They're like, well, why not? Because manufacturing jobs don't really exist anymore, right? Like, don't tell anyone, because I know every time election comes, they're going to say, I'm going to bring back manufacturing. And people will be like, yes, bring back manufacturing. I think it's more likely that all manufacturing will be gone and done by robots than it is that manufacturing will come back to the United States and hire people. Because you have to think about it from a practical standpoint. If I could have a factory that is basically machine automation with AI, and you can look them up, like I like Reese Cups. The Reese Cups factory with the assembly line and the people in the early 1900s, I think it said that they made like 100 candy bars an hour, 100 candy bars, like an hour. Or I guess cups, the Reese Cups, they made like 100 an hour. Do you know how much that the machine makes today? It makes like 1,000 a minute. Right? It's like, so if you were building a factory in 2026, would you purposely design your factory to be inefficient in the 2026 market of AI? Like, would you purposely design your factory to not use AI? And I would say no, right? You're not going to purposely design a factory to just run by people. Because even, and you can see Amazon had laid off, I think they laid off like 20,000 people because they had so much efficiencies created from their little robot. It's like one of those little Roomba vacuums, but it actually carries pallets, and it's moving the entire pallet around the warehouse in these little squares, loading up trucks and everything. So they're like, oh, dude, we're laying off 20,000. We're probably going to lay off more in the future as we integrate more and more AI. I think that that's more likely. So I say that to say that even if Taiwan invests in the United States, I don't think it's going to bring jobs here, but they have that pressure where they are taking money and having to invest it in places that are probably inefficient just to maintain that trading relationship. And then we haven't even talked about the fact that China seems like they're planning on taking Taiwan. And so when you look at Taiwan and the current way that they are run, they may not be run that way in the future. That it's just maybe run as another government arm of China, and then maybe China won't allow them to send the chips out, just like the United States told NVIDIA that they couldn't send the chips out. Like, we don't know what's going to happen with this company in the future. It is a great company right now, and based on everything, they've kind of navigated everything really well as far as dealing with the United States, so I think that one's fine. But as far as dealing with China, that one's not fine. There's a lot of hostility and volatility over there in that market. So you just have to kind of deal with that. But with all that said, it's still a great company today, but it is something that we really need to think about in the future. All right, and so that is, I think you sort of get the idea. I do this pretty much right for my clients where they're like, hey, I have some investments, what do you think? And then I'll go through it, I'll help them, because some of them they leave with me, some of them they kind of leave on their own. But I do think eventually it's like, all right, I think it makes sense to kind of bring it over. And then I'm like, sure, I'll go through it. I'll put a report together for you and I'll give you my recommendations. And then we'll discuss kind of what you're looking for, how you thought it would go. I will share with you, and do I have it? So I'll put a link in the show notes where if you are interested, where you're just like, yeah, you know what, Dre, that was pretty cool. Where is it? So I will give you just a very simple like client audit portfolio. You can get a better understanding of your stocks. Remember, I said it's all about the information. It starts with that. So you can have your portfolio allocation snapshot where you can see what percentage of your portfolio is in which industries. And then you want to see if there's any that you're kind of concerned about. The income that you need as far as what it's generating and what you need, the gap that you have, you get to get an idea on that. You have the risk and concentration audit. These are a couple of high-level things that I'll look for. Hey, more than 20% in one stock, heavily exposed in one sector, high concentration in speculative stocks, no downside protection strategy, right, and no rebalancing process, right? All of these would have been the risk and concentration, right? So there was no risk protection in what we just went through. Then you have your stock durability, and then these are a quick way to do the score. So you give a score of 1 through 5. And then you see what the score is out of 25, and then you can decide based off of that if it's like red, yellow, or green. So you could say if the score is 15 or less, I'm not buying it. If the score is 16 to 20, then it's going to be yellow, and I'm probably okay with it. And if it's 20 or higher, then it's green. I'm definitely buying it. It's a great investment. So you say portfolio fit. What does it look like with all your other investments? The market trends, we talked about some of that. Valuations, right? Is it priced fairly? Is it overpriced, underpriced? Financial health, how much debt is the company taking on? How much growth do they have? The sales and the information like that. The business model, can I easily understand how they make money, right? Like Disney, how do they make money? It's a media company, right? They make movies. You're like, cool. You be like the Taiwan chip company, how do they make money? They make chips. All right, cool. And so pharmaceutical companies, they sell drugs. You're like, all right, got it. If you run into a company that you're just like, what are you doing? And they're like, we are innovative and future forward looking. You're like, no, I'm out of here. Like that's too confusing. Right? I'm not looking for that. We just need to be able to understand how you make money. That's all we're trying to do. Hey, how do you make money? They're like, well, no. Just how do you make money? Like very quickly. Pizza, how do you make money? We sell pizza. Yes, it's true. And you're like, all right, cool. Stress test scenarios, these are just things I look at. I do like the idea of, future-proofing your portfolio. So what happens if the market drops 30%? What would that look like? What happens if inflation rises? Are you protected? What happens if your retirement comes early? Where there's real examples of that. What happens if healthcare costs increase? That's all we're saying is like, do I have the protection in place if something happens outside of these situations? And then you have your fees and tax efficiency. We didn't really get into that, but normally some of the questions you'll have is, do you know your total annual investment fees? Like how much are you paying a year? How much does it cost? Are your investments tax efficiently placed? Are you going to have an ordinary income in retirement? You're going to have tax-free money in retirement, or you're going to have capital gains in retirement, because those are three different ways of having your income taxed. And you would rather have it tax-free than anything, but you'd rather have capital gains because that's about half of the normal tax rate. And you probably want ordinary income as the last choice. But most people have all of their money in the 401k. So ordinary income is how all of their retirement is going to be taxed. And that's the least efficient one. You have the capital gains exposure reviewed, where you're just kind of looking at it. And then your Roth versus taxable allocation optimized. So how much of my money is percentage-wise in taxable accounts to be capital gains? How much of it is in tax-free accounts where I don't have to pay any taxes? Boo ha ha ha. Cue evil chuckle. And then your final portfolio rating. Retirement ready is going to be green, needs optimization is yellow, and then at risk red. And you can always schedule a complimentary professional portfolio review with Dre Griggs, your certified financial planner, right? That's me, right? So I don't talk about myself in third person. That's me, my friends. Anyways, I will just have this placed in the show notes. It's not going to have any gatekeep. You'll just be able to get access to it right away. I did want to just kind of share with you, this is sort of what I'll do. In a typical day, I'll look through it, I'll see what's going on. I'll look up, do some research, and I'll start rating the companies. And from there, I will give them recommendations like, hey, we'll keep these, we'll buy more of these. I'd recommend replacing these, and let's clean this thing up, because you should not have a portfolio that can lose 61%. You should have some guardrails in place to ensure that doesn't happen to you. As always, I'm thankful for the time that we have together. I'm Dre Griggs with Obsidian Wisdom, and until next time, stay safe and enjoy life.